Once again, guys, it's Prince Dykes here, the Royal Financial Investment Group, coming at you guys live with another great video. Don't forget to like, subscribe, share, comment, all of the good stuff. Give me some feedback. Give me a thumbs up if it's a good video, thumbs down if it's not. If I suck, then let me know why I suck. So I'm trying to get better. So anyway, hope you're having a good, blessed 2016. I got an inbox that said, hey, could you do a video teaching me about or showing me about the taxes and the taxes implications on stocks or whatever, how you pay taxes or whatever. So I don't have a lot of time, so I definitely know you guys don't have a lot of time, so we're just gonna jump straight into it. So here it is, taxes and stocks and taxes, whatever, however I name this video when I'm done recording it and placing it up for you guys. But anyway, so you got two types of taxes, short-term and long-term gains, right? Short-term is simple and easy. If you hold a position less than a year, less than 12 months, then it would be considered a short-term gain. If you hold a position more than a year, it is considered a long-term gain if you have a gain. So let's do it, break it down this way. If you bought one stock for $50, the stock price went up to $100, and you sold it 2 months later. What type of gain is that? Short term. Why would it be short term? Because you sold it 2 months later. Anything under 12 months that you hold with under a year and you have a profit from it is considered a short term gain. And if you buy a stock, you hold it 2-3 years and you go and sell it and you make $1,000 profit. Since you had it for 2-3 years, that's considered a long term gain. So short term, long term. So which one you think will have the higher tax implications? Short term. Why? Short term is, it's giving people it's giving people an incentive to hold an investment, find a good company and hold an investment. Because let's look at the whole scheme of finances. Why do we have a Wall Street? A Wall Street is pretty much a pile of money for corporations, right? We put our money into Walmart, Google, Amazon, Apple, Nike, whatever, all these different companies. These companies take our money, all the stock investors' money. They take the money, they put inside their companies to grow their companies or whatever. As the company grows, then the share price goes up, So you want to have a good flowing market. You want people to keep putting their money in. So the thing is, you want people to invest in the company and keep it for a long term. So an incentive for that, to keep people investing and to keep it for a long term capital gain tax is lower than a short term. A short term is going to be higher because a lot of times out of 10 they expect that, hey, you put your money in something, then you sold it, you're kind of speculating, you're not really investing. So to give Americans an incentive for investing long term into America, long term gains tax is lower than short-term tax. Now, another thing. Now, you don't go in there and say, hey, I bought a Netflix stock. I made $300. Oh, wow, I'm going to have to pay taxes on it. No, you don't pay taxes on it until you make a profit. It's the difference between a profit and a value. I have a video on it, but I'll go ahead and just tell you about what it is now. If I buy a Netflix stock right now, before the market closed for $100, just saying, it goes up to $130. Do I have to pay taxes on that? No, you don't pay taxes until you sell. Once I sell it, now I have a profit. Because I had it at $100, it went up to $130. I now have increased the value of it. The market value is up, but that doesn't mean it's a profit, because that can go away. We know stocks fluctuate just like any investment. It can be up one day, down another day. So that is market value. You don't take on a profit until you sell. Now, you say, okay, well, all right, I got it, Prince. I sold the stock. Now I have a $30 profit. So now do I pay taxes? No, it is a net at the end of the year. It depends on at the end of the year. Because let's say if I make a $300 profit on Netflix, and then I go lose $1,000 on Apple. Now I'm at a negative 700. Then I go on with Google. Throughout the year, you're going up and down with your investments. And let's say at the end of the year, you end up with a negative $5,000 on your trading and investing or whatever. So now you can actually write that off as a deduction, a tax deduction, that, hey, you lost 5,000. But I think don't quote me on this, but I think the max on claiming a loss is like 3,000. Then you have to carry it on to the following years. So that's a big thing. It's only, keep in mind, it's only on what you net at the end of the year. Well, Prince, how would I know what I net at the end of the year? Well, depending on your broker, I know eTrade and Scottrade and TD Ameritrade, Charles Schwab, all at the end of the year, or they should be, your broker should be giving you a tax document, 1099, telling you, giving you, summing up what your investments, your dividends, your capital gains, your capital losses, whatever was a short term, long term, all of that should be bundled in at the end of the year. Once you get that at the end of the year, you take it over to your tax professional, or if you do your own TurboTax or whatever it is. I know eTrade is automatically connected with TurboTax and it automatically uploads your stuff with your social security number. You know, it's 2016. That's how things are going. But you take your tax documents and you go file it with your tax at the end of the year. So throughout the whole year, you go ahead and you invest up and down or whatever. If you're doing very well, I would advise you to put money to the side to be able to pay your taxes at the end of the year. But if you end the year up 30,000 or whatever dollars, then be ready to pay capital gain tax. Now, Prince, hey, what is it directly? It depends on your income tax bracket. Whether you are, upper tax, you could be paying up to 20% in capital gains, or you could be paying nothing in capital gains, or you could be paying 15%. Depends on your tax bracket. Now, everything I just said, I'm just going to throw a disclaimer out there. I'm not a tax professional. That's not my forte. I am familiar with it. I do have a license as a Series 65 where, we go into taxes, but I would advise you to contact your tax professional, your CPA, or whatever to give you more detail about your income tax, and all the other things. I know dividends and stuff like that had a tax implications, but I wanted to keep it on topic of just stocks. But anyway, I don't want to keep the video too long, but don't forget to like, subscribe, comment, and share. As always, know what to do. Until next video, be safe. Peace. I'm out.